If you've been looking for a way to passively invest in real estate, chances are you've come across the term real estate fund. What is a real estate fund? How does it work? Who's involved? All of that stuff. Well, that's what we're covering in this video. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about real estate funds. And I recently did a video talking about real estate syndications, which are similar to real estate funds. And I'll put a link right up here if you're interested in learning about the real estate syndication process. So what is a real estate fund? Well, a real estate fund is an entity that buys and sells different properties, in this case, multifamily properties, because this is a multifamily real estate channel. So let's start off by working out the different parts of a fund, and then we'll go into how it has a life of its own and how it grows. So very similar to a syndication, we have a GP and an LP. The LPs are the passive investors. These are the people that are pooling their capital, their money to invest in these real estate deals. And these are doctors, lawyers, accountants, business owners, programmers, high net worth individuals for the most part, who pool their capital together, so this is the capital, and they invest it in the real estate fund. So we'll call this the real estate fund down here. So we have the LPs bringing their capital. These are the true passive investors. And then we have the general partners, the GP, or GPs, if it's a group of people, which is most often the case. These are the people with the real estate connections. They have the deal flow. They have the know-how. They know how to push rents. They know how to manage these properties, how to run the renovations, how to sell these at a profit, and really earn returns for the limited partner investors, because this is why the limited partners invest. They want a return on their money, besides all the tax benefits and all of that stuff that comes along with multifamily real estate. So we have the GPs and the LPs. The GPs manage the fund right here. Now, as opposed to a real estate syndication where only a single property is purchased, a real estate fund really has a life of its own. So we have the fund entity right here, and the fund will actually go out and acquire new real estate properties. And then over time, the fund may sell different properties, and they'll have new properties come in. They'll sell a couple, and then it'll come back in. So the fund really has a life of its own, and many funds can go on for 20, 30 years. They have a life of its own as they grow, and then they may contract a bit, then they'll grow again. This is the big difference between a syndication and a real estate fund. Like I said, a syndication is for a single property only. The investors can decide whether or not they want to invest in that specific opportunity. With the real estate fund, because it's acquiring and then selling, acquiring, selling properties, it's always moving, it's always growing, the investors don't decide on a case-by-case basis or a property-by-property basis where they want their money allocated. Their capital is spread throughout the entire fund. Now, this is a benefit because instead of investing in just one property, an investor can really diversify all the properties their capital is going into and really buy into multiple properties in the fund structure. So when an investor wants to place capital in a real estate fund, they're really investing in the fund's criteria, the set of guidelines the fund has created to guide their investment strategy. The investor doesn't get to decide which properties the fund owns that they want to place their capital. It's put into the fund itself, and it's spread around. It's diversified throughout its entire portfolio. Just as with a real estate syndication, the limited partners are afforded protections under the law because they are true passive investors. They are putting their capital at risk, like with any investment. If you invest in stocks, you're putting your capital at risk. There is risk in every single investment, but they are not on the hook. If something goes wrong and the fund falls apart, it's the general partners, the people controlling the funds, the true real estate experts, that are shouldering the risk. The LPs, they are placing their capital at risk, but that's it. So this is true real estate passive investing. This is not a partnership structure where everybody shoulders the risk. And I'll put a link right up here to my real estate partnership video where I explain why partnerships are not true passive investing. So a real estate fund, we have our limited partners bringing their capital. The general partners bring their real estate expertise, and then they create the entity. They pool their capital into the entity that then goes out and buys and sells, improves, and earns a return on the real estate the fund has acquired and turned around. So if you're interested in learning more about the deals I'm currently doing, head on over to callseth.com and set up a quick 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.